cameras are go. If you can hear me and you're in the live chat wherever you are, if you're on Google, Google's YouTube, if you're on Facebook or Meta's Facebook, if you're on Twitter, which is owned by Twitter, its namesake, please say g'day. My name's Owen Rask, as always. It's my absolute pleasure to have you with me. Let's move my microphone across a little bit. Tonight, we've got some very special guests joining us. There's, of course, Rob behind the keyboard alongside me. So if you see my name or our name, SelfWealth, in the live chat, it's either one of us. And we're going to be joined about 6:15, that's Australian Eastern Time, by Dr Anirban Mahanti, who is a fantastic investor from Seven Investing, which is a US-based investment research service. But Anirban is based in Sydney. So he's based here in Australia. He has a pedigree in Aussie stocks and also in global stocks, but his career has spanned more than just investing, much more than that. He has a PhD. He's I'm going to say this because I can say this because I'm friends with Anirban. He's probably the biggest tech nerd that I know, and that's coming from a guy who takes pride in being a tech nerd himself. So he's got some great insights on cybersecurity, on cloud computing, on many different types of technology platforms and trends, which we're going to talk to tonight. G'day everyone that said hello already in the chat. I can see Ramesh, Martin, always pocket full of shell. Welcome back. Welcome back. It's always wonderful to have you with us. So we've got a lot to talk about tonight, and I'm going to quickly dance through some of the things that we'll be talking to. So as you can see on the bottom of my screen, there it is there, limited time until the end of June 30th. You can get free trades and live price streaming with SelfWealth Premium. When we jump into the platform in just a minute, you'll see that's what I've got in my demo account. It gives you like that live pricing on your watch list and all that sort of stuff. And it also comes with free trades, and it's worth more if you don't buy it before June 30th. So if you are a loyal SelfWealth customer and you do make trades regularly, you may as well get it. So tonight we're going to be talking about basically what's going on in markets at the moment. There is a lot going on insofar as volatility. I was just talking to Anirban off air. We were reliving some of our past experiences with volatility and how that can impact us as investors and our portfolios. We're also going to be talking about two companies, being Zscaler, and we're going to talk about Apple, which is a company we've spoken about quite a bit on the show. G'day Lord Spides, g'day Bergs, g'day Emperor. Everyone, welcome to the show tonight. Wherever you're joining us from, don't forget to say hello. So just a reminder that anything that we mention tonight is limited to general financial information only. If we do answer questions, I know I'm going to get some great questions tonight. Just remember that any of the information that I give you is strictly general financial information. I don't know your personal circumstances or your goals, so you'll need to see a financial planner for that. You can find out more, all those T's and C's, and what we can and can't do in our financial services guide that's on the Rask website or on the SelfWealth website. So thank you everyone for joining us. I know it's 6 p.m. on a Wednesday. It's my favorite time of the week to talk because it's hump day and it's something fun for us to do. As always, I'm going to start off with a bit of a joke. I hope Jeremy is in the chat because he can give me, maybe if you give me a score out of 10, Jeremy, or really anyone, give me a score out of 10 on this joke. So this is an interesting one. Where can you go to buy chicken broth in bulk? The answer is the stock market. You get it? Because it's stock, it's chicken. That's my joke for this week. So I hope you like it. It's probably better than the last few weeks. If you've got a smile on your dial, that's the main thing. 4 p.m. in WA, says Adam. Fantastic, mate. Great to have you with us. And I guess that's 1 out of 10, Jason. Jeez. Emperor, 10. Jason, what? Okay. I feel like come on, that's got to be at least a 5 on average, at least. Okay, so I'm going to be quick with getting through some of the companies, our 5 most bought and 5 most sold, because I've also got some analytics on the back end of the show. We're going to do our 5 most bought, 5 most sold inside SelfWealth. We're going to jump to speaking with Anirban, talk about the two companies, and then we're going to come back and we're going to talk about basically what's going on in the market generally. I'm going to share some charts and things with you that I think you'll find really interesting. So as always, Genevieve, you give me a 5, that'll do. Tony's giving me an 8. Solid 7.75. Well, I like the decimal places, Paul. Thank you very much. So tonight we're going to talk about the top 5 most bought, top 5 most sold, and we are including ETFs tonight because there's a little bit of an interesting thing going on with the whole shares versus ETFs kind of trade mentality at the moment. So it is a little bit of an interesting market for that, if you like, inside the SelfWealth community. So we're going to start, and as always, we're going to do the 5, 4, 3, 2, 1. So in that order, 1 being the most sold. We're going to do we'll do the bought first because we're trying to be optimistic, and then we'll do the sold. This is including ASX listed shares and ETFs and global shares inside the SelfWealth community. If you guess both correctly in the live chat, you get a free value investor program on Rask, on the Rask website. So that's something that I've created, and you'll get a pass to that. It's worth $499. So if you get it, it's pretty good. Ray has won it, I feel like 2 weeks in a row now. So no pressure, Ray. I don't think you need to do the course 3 times, but we'll see. So I'm going to switch over to my screen here, and hopefully you can see what I'm looking at. So don't forget to drop your guesses into the live chat. Here we are on the SelfWealth dashboard. We are going to start with number 5. Please get your guesses in now. I will give you a clue, though. So we've got the 5 most bought and the 5 most sold. One of them, at number 1, is an ETF, and one of them is a share. So that's your clue for tonight. That's a very good clue, I would say. So coming in at number 5, it's really interesting the week that's the list, because we've kind of thrown away with some of the more speculative stuff, and I'll bring this up just now. So in at number 5, we've got Commonwealth Bank. It got hit really hard a few days ago. If we just look at the stock price chart here over the last month, it got hit really hard. Lots of volatility recently. Genevieve, you've guessed most bought Woodside, most sold. Most bought CBA, most sold Woodside. Interesting. Is the world going to crash? Says Adrian. We'll get to that in a minute. Maybe we can put that to Anirban. If Ray wins this again, we're going to have to make it harder. Yes, we are. I feel like Ray's got inside knowledge. Maybe Ray is a SelfWealth employee or something and has access to the data. So okay. So in at number 5 is CBA. In at number 4. You can probably guess, very similar, is Westpac. Westpac, the bank that's, other than dividends, it's gone sideways for quite a long time for share investors. In at number 3 is ANZ. So ANZ, very similar, had that really ambitious Asian expansion strategy under CEO Mike Smith, is now kind of has rewound under Shane Elliott. And here it is going sideways as well. You got franking credits, you got dividends along the way. So it's not too bad. In at number 2 is VDHE. Errol has guessed VAS as the number 1 bought and LKE as number 1 sold. Ray has guessed most bought VAS, most sold Core Lithium. Number 2 on the most bought list is Vanguard, Diversified High Growth Index ETF. You will remember this because we've spoken about this quite a fair bit on the show. And that's because it's a very popular ETF. It's diversified. It's kind of like, it's a basket of baskets. Remember that analogy that we used? It's basically an ETF of ETFs. Not really ETFs inside it, but that's how you can think about it. In at number 1, Errol, Ray, Jason, nearly Christopher on Facebook, who's guessed most sold NDQ, most bought BHP. It's actually VAS. So when I get the list here every week from Rob on the most bought and most sold, VAS, the Vanguard Australian Shares ETF, which invests in 300 of Australia's biggest companies, when I get this every week from Rob, it basically VAS, the most bought, and then it's Daylight, and then it's number 2. In this case, it was VDHG. Sometimes it's VGS at number 2, but it's almost always VAS at number 1. That's when we exclude the shares. Gaurav has guessed Tesla most bought. Tesla, fascinating. Jason, BHP most sold. Adam, BHP. Genevieve, VAS. VAS indeed. Okay, so now we're going to do the most sold. Obviously, it's been a very, very volatile week. If we just bring up the IVV ETF, which is the US stock market ETF, the S&P 500. If we just look at this for the last, say, 6 months, and as we can see, the more we zoom in, the more volatile the chart looks, more up and down. Here we can see how volatile it has been in a little while. So let's get cracking and let's get through this and let's try and get, like misery loves company. Let's get into it. So number for the most sold, please get your guesses in, by the way, before I get to number 1, would be fantastic. Harry's guessed Fortescue Metals Group. ANZ is number 5 most sold. So it was number 3 on my list of most bought, number 5 on the list of most sold. In at number 4, I don't know who guessed this. Who was it before? Errol, you guessed this. LKE is actually the 4th most sold. Lake Resources got quite a bit of a buzz on Twitter lately. I think it's really popular in the Reddit community, although I'm not very up to date with that. It's a company that we've talked about in the past. Quite early stage, no revenue, still a business that's very much, early stage, a bit more speculative, which is interesting that it's held up so well with all the volatility. It's actually, even though it's come back a bit there, it's actually hasn't continued to fall like some have. In at number 3, company that is very contentious right now, which is Zipco, the buy later company. Genevieve, you said, I bought some IVV this week. Very happy with the price. Well, great stuff, Genevieve. Great stuff. Tony's guessed most sold Zip and Redbubble. Interesting. So Zip is here at number 3. And we've talked about this a bit in the past, but you can see this is a really, really, I had to kick a company when it's down, not at all, but it's been a really tough run for the business recently. You may remember that Zip is a buy pay later business which prides itself on doing checks. It has made a lot of acquisitions internationally, and to fund those acquisitions, you may remember when we talked about this a few weeks ago, that it has continued shares in the company to fund that growth, which sometimes can work. It's not great when the stock market takes does a U-turn, because what happens is you've got more shares outstanding, meaning that your share ownership in the company is diluted. So Jason's guessed Woodside most sold, Paladin most sold from Kieran. So interesting. Okay, Rob, you've just said that the sound is a bit of an issue for everyone. I hope everyone can hear me. In at number 2, we've got Pilbara Minerals. Pilbara Minerals is a much more late-stage business in terms of the lithium. It is a business that has achieved some success financially. We've spoken about this. I do it every week. We can see here revenue taking off. It's also, it is bouncing back. So it's kind of hitting that stage where we think about operating leverage. Rob, I hate to tell you, it looks like sound is fine, at least according to Paul and Jason. Hopefully you can catch up already. Ignore me, he says. So here we go. We can see back to Pilbara, and we're going to go number 1, and then we're going to hopefully switch across our friend Anirban, who will be waiting in the wings for us to have a bit of a chat, and we're going to ask him to bring over some companies and talk about them for us. But at number 1, there were a few guesses for this. Jason, I know, has guessed this. Woodside Energy, the company that has just taken all of the petroleum assets from BHP. We'll have a quick look at the chart. Changed its ticker symbol, was Woodside Petroleum. You can see it here. Now a massive business in its own right. If we come back to the overview tab, we can see revenue of 11.7 billion, but market cap $62 billion. So it's now much larger, having combined those two businesses. Many people got shares in this business through their BHP split, as well as a nice little dividend to boot. So good on you if you did, and good on you if you still hold it. It seems a lot of people are selling. We'll come back to the buying and selling statistics later this show, because there's actually some really interesting analytics about what's going on with the best performing investors inside the SelfWealth community and what they're doing, which is very different to what people who aren't in the top 50 are doing. So we'll stay tuned for that. Okay, so I'm hopefully going to bring in Dr. Anirban Mahanti. Hopefully he can come in here, and we'll see if we can get him on the show. Looks like his camera's gone a bit. Let's have a look. Let's see if we can get him up. So while that's waiting to connect, hopefully we can say good day to him. And while that's coming through, I'm going to continue over to the side here. Just to let you know, Anirban, we cannot see your camera on the video. So while that's happening, while we're trying to continue here, and say that the two companies that we are talking about, we'll go like this. The two companies that we are talking about tonight are Apple, which is a company that we've got in the low tofu portfolio, and we've also got Zscaler, which is a company that Anirban has told me about before, but I haven't come across and done enough research myself. But hopefully by the end of tonight, we can add this to the high stakes portfolio. Okay, mate, it looks like we've got you. Anirban, can you hear me?
I can hear you. Can you hear me?
I can hear you. That's fantastic. So we are going to get rid of that one. I'm going to bring up side by side. Welcome to the show, mate. It's An absolute pleasure to have you with me.
Thank you for having me, and a pleasure to be here.
It's for listeners and for viewers that haven't seen us together before. We've actually done this a lot over on the Australian Investors Podcast, but it's been a little bit of time since we've sat down and had a chat. Don't forget, if you want to ask a question of Anirban or I, you can do that by just jumping into the live chat feature there and typing in your question. Maybe before we get to the two companies that you're going to bring to us tonight, maybe what I'll just do is ask a couple of questions. First one is a really low-hanging fruit for you. Can you tell us what you do at Seven Investing? Tell us a little bit about what you do every day as an investment advisor.
Yeah, so Seven Investing is a US-based research firm. Basically provides stock ideas to investors. So basically, I do research of companies. That's what I do, and we do deep dives into companies. And we write reports about companies. Most of my work focuses on sort of the technology sector. So I focus on enterprise software, EVs, a little bit of consumer discretionaries, but again focused on companies like Apple. Basically, again, the technology sector. So yeah, I look at big tech, I look at medium-sized tech, and I look at small tech. But most of the small tech that I look at would probably be pretty big tech for an ASX audience. But yeah, most of my time is spent looking at technology companies, and on the side, I read about technology and what's going on in the technology world.
So in the past, people know you from your time at as the Director of Research at the Motley Fool Australia. You've since gone back to what I would call maybe more your native ground of hunting ground for investing, which is in the United States. And you get to look at all these fantastic technology companies, really innovative technology companies. My question before I ask you just to introduce your two companies for tonight is, how are you feeling about the volatility that we're seeing, not just in the technology sector, but in the market overall? Does it make you nervous? How do you feel? You've been in a similar situation before with volatility, where some of our viewers tonight probably haven't. So how do you feel about this?
Well, I feel absolutely crushed, and it's not okay. It's not fun at all to see your portfolio, cut in half. I think I just looked at it this morning. I think our larger portfolio is down something like 56% year to date. Right, that's a lot, right? I mean, that's a significant reduction in wealth. You look at it, you open any particular day, it could be down by like 5-6%. Yeah, it's not fun, but at the same time, though, like the things that I remind myself is, look, any money that I put into my brokerage accounts are money I don't need today. I don't need the next 3 years. I don't need possibly for the next 5 years. So I'm happy to ride it out. Had I got the crystal ball, had I known that things are going to get cut by this much, I would have sold at the top and then look to buy more. I have actually been trying to bottom fish for a while, and the only thing that happens is my money runs out and I can't find the bottom. So look, when I have spare cash available, I still am putting money to work. I believe a lot of valuations that were stretched have come back. Some companies right now are fabulously cheap if they can continue executing. So yeah, whenever I've got funds, I do look to add to positions. It's not fun, but the pendulum swings a lot back and forth. Pendulum can become really exuberant, and now it's really pessimistic. The one thing I'll point out is that a lot of companies whose valuations have been cut and they've been hurting, nothing has changed with their earnings and their earnings outlook, right? So companies have had excellent outlook and still have been cut. So, the final thing I will say is when every stock goes up and your stock that you own doesn't go up, that's actually very difficult to manage, right? So you might hold, I'm just making this example, let's say you hold Disney and Disney is not doing anything, every other company is going up, that's really hard. When every stock is going down, it's actually not that hard to hold on to your companies because, you're in the same boat as everybody else. But yeah, it's painful. But, you just need to remember that these are businesses, and as long as the businesses are executing and they're they're changing the world, and they're making their impact, and they're still growing, and they have a bright future. These things happen. If you've got cash, this is opportunity.
I've got to admit that misery does love company, Anirban, and it's great to know that when there's experts like yourself that come on the show and say, yeah, it's hard. I think I'm not the only one that's watching tonight that thinks, yeah, that's nice to know that someone else thinks that too. Okay, so I asked you in anticipation for tonight's show just to bring two companies to tonight and to share with our viewers. And it's actually just a question that's just so aptly timed, and it's come from Christopher Larwood, who's on Facebook, who says, given how top of mind cybersecurity is for all companies, why has the hack ETF been going sideways for an extended time? I'm going to actually switch that question around slightly, Christopher. And I know that one of the companies that Anirban has brought to the table is a company called Zscaler. It's a company that I don't know too well. So I'm hoping maybe, mate, you can give us an introduction to the company and explain the thesis behind this company and the purpose, the value creation, the products, all that sort of stuff. Give us the 101 of Zscaler. And as you do that, I might go through on my screen here and just have a look through at the various metrics.
Cool. Yeah. So I mean, hack. I'll just say hack is it's a good ETF. Actually, I like the ETF hack. Look, so if you think about security in the old days for businesses, when I say business, I mean enterprises, large companies. What they used to do is they needed to basically build a fortress around their company's IT infrastructure, because most of the IT infrastructure was either at the head office or in some other branch offices, and you basically put firewalls and all sorts of other gadgets and deep packet inspection machines at that infrastructure. And the idea was that you try to protect this castle. So your castle basically is, your IT infrastructure, you protect it, and you only allow people with credentials to get in. So either you're inside the network physically and you're working inside the network and you have access, or you're using something like a VPN to have access. And the assumption was, if you're inside the network, you're good. If you're outside the network, well, then you're potentially bad, right? So that's the type of threat model that was being used, or threat prevention model that was being used. Now that sort of kind of broke when you started allowing people to bring their own devices, and when people started working from home, and when a lot of the workloads and applications moved to the cloud, right? So that starts breaking, where you can't really have on-prem security, right, using hardware as a solution. So the solution that needs to go towards a software-based solution. So companies like Zscaler, and Zscaler is one of the few that do this. What they did is they built a distributed proxy network. Proxy basically, think of it as a proxy, but they basically built a distributed farm of servers around the globe. And effectively, they said that any transaction that if you want to be protected in the cloud, then you basically put a Zscaler server in between. It sits in the middle between the server side and the client side, and there's a little application that runs on the client. And what it then does is all the traffic effectively then is basically now going through the Zscaler's network, right? And Zscaler then has special arrangements with various, the hyperscaler cloud services and things like that, so they can onboard traffic quickly. Zscaler then can look at traffic at speed and at scale while they're encrypted, but can do deep packet inspection. This is really hard technology to do, deep packet inspection for encrypted traffic, right? So then they can secure what they call not the network anymore, but they're securing the flow, right? So they're securing not the network, but the flow and the applications. So they did this first for on-prem applications. Then they did this for applications that are, on-prem and on the cloud. Then they added things like, is your network's quality of experience deteriorating because of security? So this is called Zscaler experience. Then they're looking at things like, how do you protect cloud workloads when you're moving workloads per se to the cloud? How do you protect them and things like that? So this is, in a nutshell, I'd call it a security as a service company, but for the cloud age is what they do. They've been growing really quickly. I think the last quarter they grew something like 60+% their revenue. They have, so they're probably on a billion point two or so run rate. still growing at 60% sort of growth rate. They have 120% plus revenue retention rate. So basically, they get 20% more revenue from their cohort every year, at 120% plus or 125% plus. I might be mixing up my numbers. They're profitable on an operating basis. They generate free cash flow. And the business, the multiples have pulled back a lot. And there's a long runway here. I mean, as you can see, if you generate a little under $300 billion in a quarter as revenue, and you're still growing at 60%, that is pretty strong. And it gives you a sense of how much momentum is there in this market. One of the things that you will hear from various security company CEOs is that there hasn't been demand pullback in this sector. And this is largely because most companies now realize that they sort of need to take what is called a zero trust approach to security, where you don't trust anything, right? That's your default positions, which means you need identity protection, you need to secure the network traffic flows, you need to do a lot of things together to ensure that. So you basically, you think of security as a layer of multiple layers of solutions. It's like an onion, and you keep peeling, you never get to the inside. Your eyes will water. That's what you do to prevent the hackers from and the bad people from having access to your network. So that's in a nutshell what they do. Fast growth, founder-led business, growing strongly.
We had a comment that's come through from Adore Oliver, who says that he's using Zscaler at Costco whenever they work from home. So there's a use case right there. So there's something you mentioned there, which was DBNR, or dollar-based net retention, which is, I know, a software metric, which basically means that existing customers pay more to the platform in the year ahead. I was reading your write-up on Zscaler on 7 Investing just before tonight's show, and I realized the company, based on the current valuation, has to grow reasonably fast. But I guess if we look at growth rates of a company, and I'm just asking if you agree on this, if we say that a company might have to grow at, say, 30% a year, right? Its revenue or sales. If it's got a dollar-based net retention, or DBNR, which is, remember that last year's revenue, last year's customers spending more this year, it makes it easier to forecast high growth rates, right? Because last year's customers are going to be spending more this year. Does that make sense?
Yeah, that makes sense. A couple of different ways to look at that. So I think that's 100% true. The other way to think about this is that when you see a software company and you think that it's not profitable, another way to think about that is effectively your sales and marketing is bringing in tomorrow's sale today. So you're spending for tomorrow's sale, which is sort of different from the previous model for selling software. Like back in the day, you'd sell software and you'd make an upfront deal, right? And you'd get all this money up front. And then you'd have an annual maintenance fee that you'd grab, right? So your sales and marketing was basically bringing in money upfront. Now sales and marketing is, in fact, when the deal is signed, that money is actually not even flowing through the door today. It might flow through 6 months down the lane and things like that. So, to follow through on what you're saying is that you could effectively say that a portion of sales and marketing is bringing in tomorrow's revenue. A portion of sales and marketing is adding revenue to existing customers, which is upsell. And maybe you want to think about that and say, well, maybe only half of sales and marketing is effectively giving me this 25% additional revenue growth, right? And when you sort of think about it this way, you would sort of realize that a lot of the software companies on an underlying basis are actually quite profitable, because if you have the sales and marketing is the big component, right? So these guys are spending well ahead to entrench themselves in the market, and they're sort of trying to get this future revenue. So that's another way to think about it. And you just realize that if you just reduce that by half, all of a sudden you'd find that here's a 20% grower that's probably also generating maybe 10-15% operating margin already, right? And then of course Zscaler is generating, and it has 20% roughly 20% operating margin currently. But on an underlying, if you think about it, it's probably even more profitable than it appears to be.
Okay, that's it's really fascinating to hear you talk about that. It's like sales and marketing is a required expense for many businesses, but if you've got a business that's already compounding on existing customers and getting the network effect of more customers, like I know Zscaler has many big customers like Fortune 2000 companies or Global 2000 companies or whatever they call it, signing up. I can see Jeremy's joined the chat and he said, my joke looks like a classic Owen joke. Fantastic. Paul said, very much agreed with you, Anirban. Tech valuations were at odds with reality. Okay, so if you have for Dr. Anirban Mahanti from 7 Investing, please go and chuck them in the chat. Frank said, I feel tech got ahead of itself, and this is just a correction now, and it's balancing out. And D-Fresh said, I went to a Magellan conference recently. They have mentioned cloud stocks are still heavily undervalued. What are your thoughts on this, Dr. Mahanti?
Yeah, so I mean, yeah, it's hard. Like on average, cloud stocks probably have pulled back a lot. Some companies right now, for example, they all have different shades to them, right? So I'll give an example. An Okta, as an example, is a company that I'm sure Owen knows about very well. That's an identity management platform. You know, this company, you know, its organic growth rate is just a tad under 40%. You know, it's pulled back heavily, and there's some things there about what happened with the Lapsus hack and how a third party got access to some of their systems. Whether or not that has impacted growth, I mean, it looks like it hasn't impacted growth. And then of course they made this acquisition of another company called Auth0. So but there are those things that I think people are concerned about. But even on a core organic basis, that's a pretty fast growing business for a relatively cheap multiple right now. And the acquisition is sort of masking the free cash flow that this business is capable of generating. So, I mean, that's an example. There's another example. Most of these companies that have been hit hard have either seen a combination of a little bit slowing down of growth combined with acquisitions. The Twilio is another company, as an example. This is the messaging giant. And when you get OTPs, one-time passwords and things like that, that comes from Twilio as an example. But again, they made a bunch of acquisitions and so people are going, well, what's happening? But that has been hit really hard in terms of its valuation. But some companies have not been hit so hard because they have been more pure organic growth companies. They have pulled back, but not hit as hard. Like the Zscaler as an example, hasn't been hit that hard. Others being Cloudflare and things like that. Yeah, but the valuations are more. I encourage people to think in terms of the free cash flow generation. And so there's still a lot of free cash flow generation baked in. So my estimate would be that something like Zscaler, the market expects them to generate 30% free cash flow growth for the next 10 years. That's a lot of free cash flow growth to get. But at the same time, this is a company growing at 60%, right? And we know that these companies have a lot of operating leverage inherently, so therefore they should be able to generate. Free cash flow should actually be at a greater pace and over the long term than the revenue growth. So, but yeah, if you think in terms of free cash flow, I think the valuations are for a basket of what I would call, if you look at a basket of class-leading stocks, I personally think that they look good value. I wouldn't say they're dirt cheap, but a lot of them are good value right now. But yeah, you should, a basket of class leading is what I would say.
Okay. Well, we've got there's one more question here, which we will have some more time for Q&A after Anirban talks about the next one. But this one's just from Jeremy. Just quickly, Anirban, how do you know if they can sustainably drive that strategy? In other words, how do you pick the right winners? Is this something that you monitor every quarter or maybe every year or something like that?
So, first, number one is that no one can pick all the winners. You just have to assume. My working assumption is that I'm going to pick stuff that's not going to work out as well, right? In my own portfolio, and I'm happy to have losers in my own portfolio, and I don't let that as a stumbling block, because otherwise you can always wait and look at trying to you can make perfection an enemy. Which I try not to do. But then at the same time, you can think about, there's some classic signs to look at, right? Is the revenue growth strong? Are large companies signing up in holds? What Owen said, the Fortune 200 folks, if you look at the companies making large dollar deals with Zscaler, that's actually accelerating at a pretty significant pace. Those are good signs. And then of course, you also need to think about the dynamics of the industry. So, advertising for online advertising has tended to be like a duopoly, or it's basically could be a monopoly as well if you want. But security is a very different beast, and nobody's had a monopoly in this industry. So you can expect multiple winners here. Also, security has multiple layers because it's not like one solution is going to do it all, right? And people are so fearful of losing online access and all the havoc that they can create, that they would actually go for multiple solutions, multiple layers to keep their IT assets secure. So security is that sort of market. At the same time, of course, you have to be aware that if something bad happens, that's really going to hurt a company, or could potentially hurt a company. So things like that. But I think you have to keep looking at how the company is executing, and then there's some natural advantages, like, for example, having a distributed proxy styled architecture that is globally distributed. Not many companies can actually replicate that, because it takes a while to replicate it, then build the technology, encryption, decryption at scale. Those are hard things to do. These are like really deep technical challenges there. So this, technical chops of the companies also matter.
There's actually a question that Jason's put up, which I might come back to, Jason, just after we get Anirban to talk through his next pick. I don't think you're going to win any points for originality with this one, mate. The company that you're bringing to us tonight is Apple. We've spoken about this on the show in the past. Maybe a very quick intro to Apple. Maybe it's something that people don't know about, or something that you like about it, is where we can take this conversation. And then if you have any questions and you're viewing tonight, please drop them in the chat and we can put them to him. So, mate, tell us a little bit about Apple. Other than the headphones, other than my headphones, other than our Apple Watches, why do you like the business?
Yeah, so I thought Apple is an interesting example of, Apple would be thought of as a company with significant headwinds in a highly inflationary environment, in a macro uncertain outlook. But I think I'm just taking a contrarian view there and saying that actually, in the current economic environment, if I have to think about, if I think about big tech, I think the companies that are likely to hurt more are Amazon, or in fact Alphabet, because advertising budgets are definitely going to be pulled down, and retail sales are already starting. Like if you just look at the inventory of some of the retail companies, it's just staggeringly high. Company like Amazon has got a lot of baggage in terms of the infrastructure is built. So this is over, let's say, next 18 months or so. The companies actually best positioned to deal with this are companies like actually Microsoft. Microsoft probably is in a very good position because of its things that it does, like Microsoft Office and so on and so forth. They're like Microsoft Teams. But Apple, because it provides sort of the goods that people use, like businesses use, so businesses would use your laptops, they would use their iPads, and it's the productivity tool that most companies would use, right? Most people also use them. So these are one of those things that I think people are unlikely to stop using. That's one angle. The other angle is that over time, what has changed is that Apple has a pretty significant services business, in addition to its consumer devices business, or devices business, the hardware business. So I think that gives them a significant advantage, because they're just getting more and more leverage out of that side of the business. Then, of course, their share buyback position, the cash position puts them in a really strong position. If the shares dip, they just can buy back more, and that helps the patient long-term investor, I think, in generating long-term returns. It's been a phenomenal hold for the last decade. Ever since Tim Cook has taken out, this has been a phenomenal holding to have in a portfolio. So those are some of the reasons. Then I think the last bit, I think people underestimate, because Apple does not talk about products before they're ready for prime time. We have a tendency to underestimate the innovation prowess of this company. If I ask people, what is the largest chip who's the best chip designer in the world? It's not Intel, not NVIDIA, it's Apple. Right? Nobody makes chips like Apple. The same thing could be said about, just look at the trajectory of their M1 chips and M2 chips. What they're doing in that sector is just astounding. So there's a lot of innovation, and and we're sort of in this lull in the period of changeover of technology. But I think we're getting very close to having some sort of AR device, and it's not going to be from a company like Meta. It's going to come from a company like Apple, which is going to make it mainstream. And then of course, look at what they're doing with buy now, pay later. They can add everybody's service as a feature to their big service pool, and they can just make it better because they just have such breadth and depth of tech and understanding. And then the final thing is such good allocators, right? This is one company that does not waste money. You can take Google, it went and bought Fitbit, it bought Motorola. Apple, what the biggest amount it has spent is $3 billion for Beats. So I mean, this is a company that is very good with capital allocation, really smart people, very innovative, and I think these are sort of things that people don't think about. So, anyways.
I've got a lot of questions that have come through, mate. So one of them's Jeremy's got a question in again here, which says, well, Apple, a good buy in the dip route now, or should he wait longer? He says he likes the R&D pipeline in vertical opportunities. And then the follow-up question is, with your argument, do you bet one of the horses or all of them, which includes Microsoft, would be better to diversify if you're playing this kind of thematic for AI and for basically inflation, beating inflation, and all that sort of stuff, like pricing power?
Yeah, so I'll throw some general comments there. So I'm not a fan of Meta. That's a company that I don't advocate in any way. I think they have got deep troubles in various different ways that's happening there. And they've got a lot of things wrong. And they've just lost Sheryl Sandberg. So they've lost the adult in the room in many ways. That stock might only exist in the metaverse. So that would not be funny. But anyways, that's what I think. Look, I don't mean to say that Google is not a great company to own. I'm just saying that in the next 18 months, you think that they would have obvious headwinds, and people might think Apple has obvious headwinds, but it probably might not. But as a basket, those are all good companies, excellent companies with fortress-like balance sheets. So your basket is probably a good approach to have. They're still growing earnings so strongly, and they're buying back their shares, which is just helping those earnings per share. Personally, I own Apple and Amazon. I don't have any Microsoft. I wish I did own Microsoft, but I didn't buy them at the right time, and then it never. I don't own any Google, but I think Google. I actually have thought about Google or buying Google a number of times, but it looks really dirt cheap. Right. So that's my view on that. Basket. I'm always a big fan of buying a basket of companies and not picking anyone. But you know what? You asked me to pick a couple of ideas, so I picked a couple of ideas here because you asked me to. But if I can, I would always go for a basket approach.
Okay, a basket approach. Yeah, I think that's for those who haven't read the book. There's a fantastic book on this, The Gorilla Game, which talks about investing in high technology, and it talks about using a basket approach too, at least until you're confident and you have conviction in the individual winners. Jeremy, back again. You said, Owen, honestly, we could see more eyebrow like Jim Carrey style that demonstrates how interesting this is. It's great. Pocket Full of Shell says, love the meta/metaverse joke. Timely. Okay, so
I thought that joke better than your joke, probably.
I feel like it was much better than my joke. It was much better. So we've got that question from Jason, which I might circle back to. Jason just said, just made it more of a comment and said, routing all traffic via a central location is dangerous as networks, whilst now are more robust than ever before, still gives a point of failure. How would you respond to that?
Okay. Yeah, so it's a good question. So first of all, I said it's not a central location because they've got distributed servers across 150 or whatever locations. So it's not centralized in that sense. It's one service. Yes, if that service is taken down, somehow, then it would be a big deal.
Mhm.
But you've got 150 or 160 or however many number points that you need to actually break. So it's just designed like a distributed system, like the internet. It's distributed on the internet. It's exactly in many ways it's like saying that it's very hard to take the entire AWS down, right? Yes, East Coast might go down, but West Coast would still be up, and maybe Europe will be up, and Australia will be up, and things like that. So it's not like that, and they sort of provide the traffic routes through the sort of the closest paths and so on and so forth to give you the best performance that you can get. And from a security point of view, you use them, and then you'd have other layers on top of it. So you might have octave identity and things like that.
Okay. So, and this comes back to your point, I guess, before, is maybe not just one point of failure. You're not using one like route and one device or one service through Zscaler. Okay, fantastic. Mate, this brings us to just about the end of the chat. I want to say thank you for coming on tonight. I know it's a Wednesday night. You've probably got dinner cooking in the background there. I know you work remotely because the team's in the United States, but for people that want to find out more, you can head to 7investing.com. You can find plenty of articles, podcasts, and so forth there. You're also quite a prolific Twitter user, Dr. Mahanti. Is that, if I'm not mistaken? How can people find you on Twitter?
Or just, I'm at 7A Mahanti on Twitter. Yeah, come say hello on Twitter. Chit chat. I would respond to most people who have a question or have a comment, or and yeah, come and talk to us on Twitter. I'm always, Twitter is a great place to actually chit chat about tech and stocks and markets and energy markets and whatever else you're interested in.
Fantastic. Well, I'll put a link in the comments and in the description. But thanks, mate, for joining us, and good luck on behalf of Rob and I. Thanks and good luck with the volatility, and be head above water. And we'll see you next time.
Yeah, thanks for having me. Bye-bye.
Bye. Okay, ladies and gentlemen, thank you for having a bit of a chat with me and Anirban. Now I'm going to spend about the next 10 minutes just going on and talking about something that is probably more general in nature insofar as the market at large. And feel free to write your questions in. I just want to bring this up because it's something that I've spent a bit of time on this week, and I got a bit of good commentary and feedback on social media about something that I just wanted to bring up as a result of all of the volatility that we're seeing recently. So if I bring up my screen once again, I just want to kind of remind everyone of some of the things that we see from behind the screens when we talk to investors or when we see the data. Rob's just dropped a link into the chat there with Anirban's Twitter feed. So please jump on and give him a follow. He's a fantastic follow on Twitter. So as you can see on my screen in front of me here, this is the same chart I've brought up again and again and again. And this shows the S&P 500, which is, as I think it was Genevieve or Bob Full of Shell mentioned earlier on. Basically, this ETF tracks the S&P 500. In the United States, it looks like this. And this ETF is just investing in diversified companies throughout the United States. Now, this chart from Charles Schwab shows if you had $2,000 invested every year from, I think it was 1993 all the way up to 2012, you just put that $2,000 in on the lowest day of that year. If you just put it in on January 1st, if you broke it up and you put a bit in every month, or if you bought at the worst possible time that year, or if you just kept your money in cash. This simulation shows the 5 different scenarios. And again, what I want to show you here is that, yes, past performance is not necessarily indicative of future performance. However, we can see from this chart that just investing is actually sometimes the best and oftentimes the best remedy when you're in a state of uncertainty, when you're a bit worried about the market, and when you're worried about whatever it is. Having that long-term mindset and having a diversified portfolio is a great way to kind of stay the course. Now, I'm actually going to bring up some data that Rob sent me earlier on. Now, as you will know, inside SelfWealth, when we look at some of the different, buys and sells every week. We typically do the top 5 bought and the top 5 most sold. By the way, Rob, I'm not 100% sure if someone won this week. So if someone didn't win, that's probably means we don't give away anything this week, which is a shame. But if someone did win, please speak up in the chat and let us know. And so when we do these every week, we talk about the top 5 most bought and sold, but some of the other analytics are even more powerful for us when we look at them. So Rob dug up some analytics from SelfWealth just today, and he said, amongst the top 100 investors, so remember how we can see the profile of other investors, amongst the top 100 investors inside SelfWealth, and remember there are 120,000 SelfWealth users, the ETF to stock ratio, so how much is ETFs, how much is stocks, is ETFs are typically in the top 100, 51 versus 49 for stock holdings. Now, when it's in the top 50 members, so in the top 50 members, the weightings, which are fascinating, are actually 57% ETFs and 43% individual stocks. So we're seeing more of a skew to ETFs and that diversification. Now, in the top 50 members, so not just a member here, but in the top 50 members overall, lately, there has been more buying selling. So 52% of the trades are buys and 48% are sells. So 52, meaning that there's more buying and selling going on. So yes, and that's for the individual stocks. Sorry. And for ETFs, get this, amongst the top 50 investors inside SelfWealth, those that are buying ETFs, there's 70% of those trades are buys and only 30% are sells. So the top 50 members who have ETFs in their portfolio, 70% of those trades are buys. And I think that this brings, I guess, more real world kind of, validation to the point that we're seeing more and more every week, more and more SelfWealth members using ETFs and using like sensible investment strategies. That might be, even if they're not just using ETFs, they might be using shares, everything inside SelfWealth. They're just doing it regularly. And that comes back to this thing right here. They're just investing. As Dr. Anirban Mahanti just said, when he has spare cash, he just invests. I feel like that's such a simple way to kind of live your life as an investor, as long as you've got that long-term wealth mindset and you've got your debts paid down, all of these things. Okay, so recency bias is something that I wanted to bring to the show. This is something that I alluded to a few weeks back, and I wanted to show you this because at the moment, what we see when we look at, say we look at, I don't know, a company. Let's bring up Apple again, right? So when we look at Apple and we look at the forecast by analysts. Now I'm going to pick on analysts a bit here. I'm going to pick on my profession and see if I can bring this up. So here we can see the skew of kind of like analyst targets and analyst valuations over time. And we can see there's mostly green because most analysts are pretty positive when it comes to. But if we look at, say, something, maybe this might show us a bit more spread. But look at Meta, there's more of a spread with people, investors saying hold. Now, what I've found time and time again when it comes to the stock market, and it's not just analysts, it's also economists, it's also journalists who write headlines, is when the stock market's going really well, a lot of the time people use the recent information, the recent, I guess, past in the stock market and forecast really strong results into the future. They say, last year the stock market went up 10%. This year it's going to go up 12%. But then things start to take a turn for the worse and they come down. And then on the way down, the forecasts get more and more pessimistic and more negative because it sounds right. Look at this history. We've just been through a negative experience and it sounds right. And this is why I oftentimes get a little bit, I guess, jaded with forecasts and a little bit disgruntled with some of my fellow analysts and economists in the industry. And I think maybe investors would be better off just forming really good habits, setting a plan in place and setting really good habits like dollar cost averaging, that is buying the VAS ETF or buying the IVV ETF or buying CBA shares or buying whatever you're investing in and just buying regularly, because the data seems to suggest this works. And also we know that habits formed with money don't take that long to form, but once they've already formed, they're very, very positive. Now, if I keep going down, another thing, and this chart comes, I think I've mentioned this on the show once before, but this chart comes from Morgan Housel. And what it shows you is in the bottom left corner of the graph, we can see emotional clickbait. So that would be like really like when you see bloodbath in the headlines or X number of dollars wiped off the stock market. And up in the top right-hand corner, we can see actual news or analysis that requires me to take immediate action. That is extremely, yet the emotional clickbait, the uninformed analysis is very common in investing. So the stuff that we have to pay attention to is actually, there's not much of it. Because if we have a long-term wealth, let's say we're going to invest $500 a month for the next 20 years, and we're going to invest it in a diversified portfolio in SelfWealth, it's really easy just to set that in motion and just keep doing it. Whereas, I think it's Jason Zweig, the Wall Street columnist, once said that he's paid an annual salary to say the same thing 200 different ways a year, because the principles of good money and investing don't change all that often, but the news has to. I've got two more charts and then I'm going to switch back to the chat. But here we can see this graph comes from Robert Shiller, pretty famous. I think he's a Yale professor. And it shows you that since 1871 through to 2012, so it's quite a length of time, if you held shares for 1 year and it was rolling 1 year periods, the worst return you would get in the S&P 500 is negative 38%. The best is 53%. And if you held for 2 years, 3 years, 10 years. Now, what I want you to see here is that over rolling periods with a 10-year investment horizon, if your portfolio is invested for 10 years, the worst return that you would have got in this diversified portfolio is negative 4.4% per year. And the best return over a 10-year period would have been 18%. But if we keep going, then we go 20 years, 30 years, you can see the negatives. Again, past performance is not necessarily indicative of future performance. What we can see, the longer you invest in a diversified portfolio, as insensibly, the more likely you are going to get positive returns over the long term. Now, interest rates and all these different things are something that is pretty scary to a lot of people. Another chart that comes from Professor Robert Shiller is this chart right here. It's called the CAPE ratio, the Shiller P ratio. And what it does, just as a quick primer on this, what it does is it looks at the entire stock market and it says, what's the valuation of stocks in the market relative to their earnings or profit? And you can see the higher the ratio means the more expensive the stock market is at that time. Here it is. This figure was taken from yesterday, and you can see based on the long-term average, the ratio is still above average. So if you look at the entire stock market and all of the different shares in the United States, the stock market is still above average. Now, some people say that means it's got to keep falling. The stock market has to cling to its average. I would say maybe, but maybe not. Here in Australia, we're actually at very close to our long-term average of 17, a price earnings ratio of 17. So we're actually right on that. Now, the thing is, and I'll be finally just this last chart here. This is the US unemployment rate. Now, for me, I look at this unemployment rate and I see this gigantic spike of unemployed people in the United States during COVID and then a massive fall. I think to myself, is it any wonder that we've got inflation right now when this happens? Everyone is unemployed, then everyone is fully employed and getting stimulus. I don't know. I'm not an economist and I'm not making a forecast here tonight. But what I will say is I don't know if necessarily the inflation could be here forever. I'm not an economist, but either way, I think my presentation tonight, this very quick presentation, makes me think, why even bother to forecast all those things as an individual? I don't need to forecast them. I'm not smart enough. All I need to do is stick to what I know works, and that's being good with money, investing regularly, having a diversified portfolio, forming good habits, and staying focused on the long term. So if that resonates with you in the audience tonight and you viewers, I can see we've got a lot of questions. Jason's asked about AGL. I haven't actually done a lot of research on AGL. Jason, I know an analyst who has, Lachlan Burr Jensen. He's on Twitter. Lachlan Burr Jensen, that is. He's done a lot of coverage of AGL's whole thing that's going on at the moment. So maybe I can refer back to you in a couple of weeks. We'll go and have a look at that. Okay, so Jeremy, you said, shout out again. This walkthrough yesterday actually helped me alleviate my anxiety of the market and feel better about the future. Well, that's what it is, Jeremy. You know, the only reason that we invest for the long term is because we are optimistic about the future. If we weren't, then why would we invest in anything? We just consume all of our money right now. Christopher, you've asked, when did the market last crash twice in the space of 24 months? That's a really good question, Christopher. I don't actually know the answer to that. I do not actually know. Jeremy said, if you wanted to give away freebies, just saying, Rob, true, relying on the chat here, who was it? Okay, Harry, here's a serious question. With rising interest rates, would you now consider having a percentage of the portfolio in TDs, so term deposits? Harry, so I'm going to bring my screen up again and try and get my words out of my mouth. A few years ago, we recommended this ETF to our members over at Rask. Now, this ETF is just a standard ETF that invests in government bonds, right? It's very simple bond ETF. But when interest rates rise, a typical government bond falls in value. So you can see that one here, it's fallen in value. Now, pay attention to the axes because the axes can sometimes throw you off. They told our members that they should have switched out of a government bond ETF and into a term deposit, because when you're in a term deposit, the value of your term deposit doesn't rise or fall like a bond ETF would. But there will come a time, well, now it's higher, maybe it is time to look at term deposits and whatever. I was speaking to a financial planner just this week. His name's Drew Meredith, and he was saying, if a term deposit provides all of the income that you need from your investment portfolio, then a term deposit is all you should have. But if it's not enough, then you have to balance the risk and reward of investing money. So as interest rates go higher, term deposits get more appealing. So it's great for retirees. Stevie, you've said, I think I should take a 3 to 6 month break from investing, out of sight. And yeah, you can just put it on autopilot if you will. Okay, so we've run over time. It's 7:03. Jeremy, Owen, to say you're not smart enough, even in the context you've stated, is untrue and a good representation of yourself. My 2 cents. Oh, well, thank you. Stevie, you said, new MacBook M2 chips coming out soon. Will we see a spike in demand despite of inflation? Well, this is interesting, Stevie, because what we saw with Apple is, this is my 2 cents. What we saw with Apple when they raised prices and they brought out the M1 MacBook was we saw huge demand. And it wasn't actually inflation that was hurting Apple's ability to capitalize on that demand. It was actually the supply chain because of all the issues going on in China with or COVID outbreak and ships not getting to ports on time and so on and so forth. So for me, I see Apple's hardware business as vital to its long-term success, pardon me. But I actually see its services business. So when you pay for storage, or you pay for music, or you pay for this type of software, that's where Apple's real future is. So that's the thing that I pay attention to. That's called the services revenue. So fantastic night tonight, everyone. Thank you so much for taking some time out to join me, Rob, and Dr. Anirban Mahanti from 7 Investing on the show. I'll turn this off now. I do have my quote to leave you with, and I'm going to bring it up on my document wherever I've just misplaced it. Here it is. And here is my quote. And this comes from JP Morgan, not the bank, the person, JP Morgan. And it goes a little something like this. It says, in bear markets, stocks return to their rightful owners. And I think that's a really apt quote for when we are in a quote unquote bear market. Stocks return to their rightful owners. But rightful being the investors who have the safe hands, who are calm, who are long-term focused. Sparky, another day tomorrow it is indeed. Thank you, everyone. Thank you, everyone. Jason said, a good joke can't be found. Actually, I do have one more joke. A magician was driving down the road and he took a driveway. That joke comes from my co-host on the Australian Finance Podcast, Kate Campbell. If you're watching, that one's for you. So this is the place of great jokes. Hopefully Rob can give me a joke next week, or he can present his own joke as well, because it's a more of a family affair that way, and I don't feel alone giving out these bad jokes. Don't forget, you can find us on social media, hashtags SelfWealth Live. You can watch all of the episodes on replay. Don't forget to hit subscribe. We'll be back next week. We did have some fantastic recommendations for guests to come up on the show. So we've got a heap of stuff planned. Looks like Rob's accepted my challenge of a joke, so that's fantastic. Thank you, everyone, once again. We'll be back next week. Don't forget to hit like, subscribe, and don't forget that SelfWealth Premium offer expires June 30th. Let's bring this up on the screen one last time. If we go down here, where are we? Here it is. Look at this. This is the one that we want right here. So that's a promo for SelfWealth Premium. You saw it in my account. You can take advantage of that on the website. So thank you, everyone, for joining us tonight. See you next week. Remember, stay calm, onwards and upwards. The world is becoming a better place, and you as an investor can capitalize on that value creation. So thank you so much. We'll see you next week.